Okay, good evening everyone. This is Love for Accounting. Today we are going to work on our third set of paper for June year 2021. So let's start. Last time we used 2.5 hours. Let's see if again this time we can control it. The time to be under 2 hours. Okay, hopefully we can do this. Okay, so let's start. Okay, again, total mark for this paper 100 marks, 5 questions. 5 questions in total, all compulsory, no choices to be made. Okay, first question, let's see, we have 1, 2, 3, 4, 5, 6 items. Okay, look at what we need to do. Okay, calculate the adjustment. Okay, we have to be careful. We have to calculate the adjustment, not the amount to be shown. Okay, the adjustment for inventory and the adjustment for allowance for doubtful debt, and then complete the extended trial balance. How many marks do we have for the extended trial balance? 14 marks. Okay, and then 2 marks to define the term suspense account, and 19 marks in total. Let me change the paper, the question details first. Okay, the question we have extended trial balance. Okay, 3 pages in a row we have extended trial balance. Okay, very important topic. Okay, so bear in mind, inventory adjustment, adjustment for inventory and also adjustment for allowance for doubtful debt for the first 3 marks. So Sam provided the following information in addition to the extended trial balance provided on the question paper. Closing inventory included damaged inventory costing 720, which could only be sold for 820 after repairs costing 120. Normal selling price of this good 900. Okay, so originally net realizable value 900, but now we have to calculate 820. 120. So this is the cost, and we have to calculate net realizable value being 820 minus 120, that is 700. Okay, 700. Then we compare the two, 720 and 700. There is impairment. Okay, impairment of 20. So one of the adjustment will be 20. Sam received goods costing 400 on sale or return basis. These were recorded in the purchases day book and included in closing inventory. It had not been decided yet whether to accept these goods or not. So, goods received on sale or return basis. Okay, that means our suppliers send us the goods. Okay, and we have to decide, okay, if we accept the goods, then it is our purchases. But then it is told that there is no decision made yet. Okay, that means it should not be our goods yet. Okay, so here we can see we are told that this 400 is recorded as purchases already and included in closing inventory already. So I think it is quite straightforward that of course we have to adjust for the 400 here, okay, as one of the adjustment in inventory. Okay, but then apart from inventory, please also remember we have to correct the purchases as well, because goods sent on sale or return basis, no decision made, then it shouldn't be our inventory, shouldn't be our purchases, shouldn't be the amounts that we owe to our suppliers. No decisions made. Okay, so remember we have to make the adjustment for purchases and trade payables as well. Okay, so let's scan through. Well, there is no more about inventory. Okay, so the first thing we do about inventory, the adjustment, okay, would be minus 20 and then minus 400. Okay, so this is from item 1 and item 2. Let me change it to red so that you know this 20 is from the impairment. And then 400, okay, this is from the second item, the goods received on sale or return basis. So we have negative 420, okay, decrease. Okay, you can see here. Okay, so okay, so next, we have to deal with the allowance for doubtful debt. Okay, we can see for item, this is item 1, item 2, okay, and then 3, 4, 5, 6. Okay, so we have we cannot skip, okay, because when we calculate the allowance for doubtful debt maintained at 5%, okay, we have to make sure that we know the updated balance of our trade receivables, okay, and there are adjustments before item 6 that is related to receivables. So we have to finish 3, 4, 5 and then go on to 6. So what we're going to do is, okay, I have to skip this part A2 first, and then we finish the items, okay, and then go back to item 6. Okay, that is the adjustment on allowance for doubtful debts. Okay, so first of all, closing inventory, okay, statement of financial position, okay, the 420 adjustment. Okay, 420 adjustment first. Okay, so adjustment for extended trial balance, we have to first of all look at the original balance. Okay, closing inventory. Okay, for the statement of financial position, it is a debit account, and then for the closing inventory in the statement of profit and loss, it is a credit account, not credit account, but credit balance. Okay, so originally it is debit and credit. So if we have to reduce the amount, we go to the opposite side. Opposite side. Okay, 420 here and 420 here. Okay, so you can see opposite side of the original balance so as to reduce the amount. Okay, item 2, let me go back to, the purple color. This is 1 and 2. 1 and 2. Okay, we have to reduce the amount of purchases, okay, which is in the debit side, and then trade payables, which is in the credit side. Okay, so it is included in purchases and trade payables because it is entered into the table, purchases table, so we have to reduce 400 here, item 2. Okay, 400 here, item 2. Okay, so the markings in the brackets is just for our own reference. Okay, we don't need to show it when we work on the answers. Okay, so item 1 and 2 finish, and then we have to go on to item 3. Item 3, let us make it green. Item 3. No entries have been made for the check received of 15,000 from a credit customer and the bank charges of 315. Okay, 2 items in one description here. Okay, so it is a check received and the bank charges, okay, or omission in full. Okay, so we just put it back. Receipt of check 15,000. Okay, this is item 3. Okay, trade receivables 15,000. Item 3. Okay, so you can see bank, it is in the debit side, so if you receive money you have more. Okay, receipt is in the debit side of the bank, of course. Okay, and then trade receivables, it is a debit side account. When you receive money from your receivables, you have to reduce the amounts that they owe to us. Okay, and then pay bank charges 315 or 135. Let me go back. 315. Okay, so bank payment 315, also item 3. Okay, and then you go to bank charges 315. Okay, bank charges, expense account, it is in the debit side of normal balance debit side, and then if you want to add to your bank charges, add to expenses, debit. Item 3 finish. Okay, let's go on to item 4. Sam paid office expenses 1500 using his own money. This had been recorded in the office expense account. No other entry had been made. Okay, so this is a negative drawings. Okay, usually when we have the companies from the company's account paying for personal expenses, then it is drawings. You have to put in drawings and then reduce the amount. Okay, but then this time, okay, it is the other way around. Okay, office expenses should be paid out from the bank, company bank account, but instead of paying out from the company bank account, you pay it from the personal account of the owner. Okay, no other entry has been made. What had been recorded in the office expense account. So this is correct. Okay, but then the other entry, it is not a payment from the bank. Okay, it is an injection of capital. Okay, if it is company paying for private expenses, then it go into drawings. Okay, if it is the other way around, actually it would be, okay, let me use light purple maybe. Okay, here 1,500. Okay, item 4. Office expense is correct. Okay, so what you need is the suspense account, because in the original entry, just one side of the entry is made. Okay, so it is an error of omission in part. Okay, and you put back the correct other entry, that is crediting capital, crediting equity, and then the correcting entries is debit suspense. Okay, so again, equity is a credit side account, so if we want to increase the amount of capital, then it is crediting. Okay, let us go on to item 5. Let me use blue. Item 5. Credit note issued to a customer 2340 have been credited both the trade receivables and account and the purchase returns account. Credit note issued to customer, okay, that would be your sales returns. Okay, sales returns. If you have a sales returns, the correct entry would be debiting sales returns and crediting your trade receivables. So this is the correct entry. Let's see how it is done in this case. Okay, so this credit note issued have been credited to both trade receivables. That means crediting receivables is correct. Okay, but then you also credit purchase return 2340. Okay, so it is incorrectly credited 2340. So you will do this purchase returns 2340. Okay, debit purchase returns. Okay, because it is incorrectly credited, so you correct it by debiting it instead. Okay, and then we go back to sales returns 2340. Put back the correct entry. So the corresponding credit entry 4680 would be in the suspense account, because when you make the mistake, okay, you credited 2 times. Okay, and now for correcting this mistake, okay, you debit purchase returns, debit sales returns, and then the corresponding entry would be suspense. Okay, so this is item 5. Okay, so you can see so far when we make the put the entry in the adjustment columns, we always have the same amount in debits and in credits. Okay, you have to do that. Okay, always double entry system. Okay, so now we have finished until item 5. The next one is we have to provide for depreciation. No, sorry, not depreciation. Provide for allowance for double debt. So let us look at use this yellow trade receivables. Okay, now it is 45600 minus 15,000. The adjusted amount would be 10600. No, why? 45600 45600 4. Hey, what happened? 45600 minus 15,000. Okay, you have 30600. Okay. Okay, so 30600 multiplied by 5%. 30600 multiplied by 5%. The new balance is 1530. Okay, so this is new balance of the allowance for double debt account. Okay, and then we have to go back to the old balance, original balance. Okay, allowance for double debt balance is in the credit side. So original balance is 2450. Now it becomes 1530 when we compare why it become blue? 2450 minus 1530. We have 920. 2450. Yes, 920 negative. Okay, reduced by 920. So allowance for double debt is a credit side account. So if we want to reduce the amount, okay, it will be debiting. And when we have to reduce the amount of allowance, there is an income, other income. Okay, so allowance for double debt adjustment, you have an income. Income is in the credit side, 920. 920. Okay, so going back to part A, A2, what is the allowance for doubtful debt adjustment? Okay, you have negative 920. Okay, decrease again. So up to now, we have finished part A and B. Okay, that will give you 3 marks here and also 14 marks here. Okay, so next we have to define the term suspense account. Okay, we have explained this suspense account for more than one time. Okay, suspense account, it is for me to score the 2 marks. Okay, we have to mention it is a temporary account. Okay, the nature first. Okay, there's actually no nature. Okay, because it's not asset, not liability, not equity, not expense, not income. Okay, it is a temporary account. Okay, if we have to explain suspense account itself, okay, it is that temporary account that holds the balance or holds the difference between the total of the debit and credit balances in a trial balance. Okay, it is a balancing item. Okay, if you cannot balance the trial balance, then the balance itself, difference itself goes into the suspense account. If you have to explain more, okay, then a point identifying and correcting all the errors, then you should be able to get 0 balance to clear the balance of the suspense account if you have to write more. But then for 2 points, okay, it would be fine to just say that it is, first of all, a temporary account and what the balance means. Okay, so extended trial balance, question 1, finish, 19 marks. So, next question. Okay, let us take a look. Next question. Several items given to you, and we have to calculate the agency fee account, rental income account, and then the profit for the year, and accounting concept, and then some identification of expenses, not expenses, but items. Okay, classification. Okay, 4 marks. Wow, that is 20 marks. How come? Okay, 4, 6, 6. Okay, 20 marks here. Seems we are not working on a lot of things. Okay, good marks for you. Okay, so this one is actually other receivables and payables, prepayment and accruals stuff. Okay, so this type of question we have, you should know it in the 2nd level already. Let's see how much more difficult than it is compared to the 2nd level accounting. Okay, so let me write the topic first. Other receivables and let me payables. Okay. So, agency fee, rental income, okay, and then calculate the profit, and then something else. Okay, so let us get the easy marks first. Okay, the classification. Identify, indicating with a tick, in which section of the statement of financial position, okay, statement of financial position, each of the following will be shown. Current asset, current and non-current asset, non-current liability, okay. Agency fee on owing, okay, accruals, owing, the amounts that we need to pay but haven't paid yet. Of course, it is the current liabilities, unless you are told that this owing should be repaid for after more than 1 year. Okay, usually not. Mortgages, it is a non-current liability. Properties, non-current asset. Rental income owing, income in arrears. Someone owe you the income that you should receive. Okay, so it is other receivables in the current asset section. Okay, 4 easy marks. Okay, so let us go back. Agency fee account, rental income account. So this should be an expense, this should be an income. Okay, let me draw the format first for you. So here, okay, an expense account, okay, is in the debit side. We have a debit normal balance in the debit side. Okay, and then for income would be a credit side account. Okay, so let's see. John owns several properties that he rents out through an agent who charges a fee of $500 per month, payable monthly in arrears. Okay, you enjoy the service first and then pay afterwards. Okay, so if it is paid at the end of the month, okay, then there is still no owing. Okay, but then let's see how much in arrears. Okay, so on the 1st of January, a tenant owing $3,500 left a property without paying rent, which was written off on the 30th of June. What is our year end? We have to make it clear first. Okay, let us go on to year end. Prepare the following accounts for the year end 31st December. So 31st December is our year end. Very good. Okay, that will be very neat. Okay, so year starts on the 1st of January, year end 31st of December. Okay, and our year of concern is for year 2020. Okay, so on the 1st of January, they owe us $3,500, but then left without paying us. So we write off in the middle of the year. During the year, rental income 97400 received, which included owing of 1,400 at 1st of January year 2020. Oh, I see why it is in the third level. Okay, and then John also paid admin expenses. So admin expenses is not related to our two ledgers account that we are working on. Okay, but then it will go into our calculation of profit. And also we have insurance. At 31st December, rental income of $2,000 was received in advance. Okay, and 4,500 was owing. Okay. 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 So let us take a look. Rental income first, because we are given more information on rental income. So we are not told about any income in advance at the start of the year. Okay, only income in arrears. Okay, income owing to you. So year 2020. 1st of January, we have a balance here, balance brought down. So this one is an income in arrears or income owed. Okay, I like to use in arrears for income to make the difference clearer for myself. Okay, so what is the amount of income in arrears? Okay, we have that bad tenant that is not going to pay us. Okay, and apart from that, where is the, yes, here, we also have this 1,400. Okay, so 3,500 and 1,400, making 4,900 in total opening. Okay, so amount owed to us, okay, it is an income in arrears. We should have received, but then we haven't received, so it is a receivable for us. So it is our asset, so it goes to the debit side. The opening balance is in the debit side. We have to make that decision, okay, every time we put the opening balance. Okay, decide, okay, logically whether it should be in the debit side or credit side according to the nature. Okay, other receivables, assets, so it is a debit side balance. Okay, so what's next? Okay, would be 30th of June. Okay, in the middle of the year, we have decided that this tenant owing us 3,500 will not repay the amount to us. Okay, so we have to write it off. What it is irrecoverable debt. Okay, so next, okay, other things are not told of date. We are not told of the date for other items, so everything goes into the last day of the year. Okay, we have received money. Let's see how much. Amount received, total amount received for the year 97400. Okay, so 97400 here, total amount received. Okay, and then the remaining item would be like this. Okay, I will write the items first and then the figures. Okay, so what's remaining would be the balance and the amount to be transferred to the income, to the statement of profit or loss. Okay, year 2021, 1st of January. Okay, we have the balance brought down. This side is the income in arrears. Okay, so we don't have to think to decide on the debit or credit side anymore because we have already done so. Okay, we just follow. If your opening balance is correct, then the closing balance should be correct for you too. Okay, but then of course if you make the wrong decision in the first place, okay, you will get everything wrong. Okay, you will not be awarded any marks if you have reversed everything of your account. Okay, nothing. So make sure you have to decide it correctly in the first place. Okay, and then the other side, balance brought down will be your income in advance. Okay, the amounts that you receive in advance. Okay, and then the two balances, okay, will be from the opposite side. So here you have 31st December balance carry down. Okay, this is in arrears. Okay, you do not have to give the items, the description in brackets. Okay, so it is just helping us Okay, this is in advance. So how much? Let us put the item first. 2,000 owing, is it? No, 2,000 was received in advance, 4,500 owing. Okay, so owing 4,500 in advance, 2,000. So it goes to the opposite side, 2,000 here, 4,500 here. Okay, and then last of all, you have to decide how much goes into our statement of profit or loss. Okay, let's find the balancing item. 3,500,974, 4,500, 2,000, 4,900. We have 9,8,500. Okay, later this item also goes into the calculation of your profit. Okay, so we finish one rental account, 6 marks, and then we have to work on the agency fee account. Let us take a look. We only have one line about agency fee. Okay, 500 per month, payable monthly in arrears. Okay, from this I have to make a decision. That means it is paid 1 month after the amount is due. Okay, that means in January you are actually paying for December. In February you are paying for January. Okay, 500 per month. Okay, so this is easy. If you have owing is a liability for you, other payables liability. So it goes into the debit side. Credit side, liabilities credit. Okay, year 2020, 1st of January, the balance brought down, it is an accrual for you. Okay, expenses accrued 500 for December last year. Okay, December last year. Okay, so if you keep the pattern, okay, for January you are paying for last year's December's fee. Okay, and then so on and so forth. For February you pay for January, and for December in the current year you pay for November. That means at the end of the year you still have December outstanding. Okay, so you are paying for 12 months, you have 12-month expenses, but then at the end of the year you will still have 500 owing for December year 2020. So quite simple. Okay, so everything goes into the last day of the year 2020, 31st December. Okay, bank, every month you pay, so 500 multiplied by 12, you have 6,000 payment. Okay, credit bank, debit and expense account. Okay, and then also at the end of the year you have to transfer to the statement of profit or loss. Okay, 6,000 for the whole year. Okay, and then the balance being 500, 31st December, balance carried down. Okay, this is your accrual again for December. Okay, so year 2021, 1st of January. Okay, you have this balance brought down 500. Finish. Okay, accrual for you. So this year you have agency fee of 6,000. It will again go into calculation of your profit, net profit. Okay, so that would be our next part, calculation of net profit. Okay, you will, first of all, you are given 4 marks for this. Okay, first of all, you have that rental income 9,8,500. Okay, and then you have agency fee expenses 6,000. You do not have to follow any format because it is just a calculation. If you are asked to work on a statement of profit or loss, then you follow the usual format for the statement. Okay, so what else? I remember we still have 2 more items of expenses, okay, but I'll tell you, okay, you might have missed out one, very easily missed out, be careful. Okay, so admin expenses first. Let me copy down 395701200 for what, okay, not 2. Okay, we have to make the adjustment here first. Admin expenses 39570. This included in it. Okay, be careful. So this included 1200 for the 4 months ending 31st March. Okay, our year end 31st December. But then in our admin expenses, it includes some prepayments. Okay, so 1,200 is our insurance for 4 months. Okay, that means 300 per month. Okay, and we have this amount until this expense until 31st March. That means out of 1,200, okay, we have 3 month prepayment. Okay, that is 900. Okay, so this 39570, we have to reduce it by 900. Okay, for prepayment, the adjustment is negative because we have paid for it. This is our payment, but then it is not our expense. Okay, it's next year's expense. Next year we have to add it back 900, but then this year we have to reduce it by 900. So 39570 minus 900, we have 3x670. Okay, so now let's go to the page. 8670. This is admin expenses. Okay, so 3 expenses. Finish? No, 1 item. Be careful. We have irrecoverable debt. Okay, it is calculated in our let me write it first. Irrecoverable debt. It is calculated in the account for the rental income. Okay, and with these 4 expenses, we can calculate 4 items, 3 expenses, 1 income. We can calculate the amount of profit for the current year. Okay, being 50330. Okay, so this is our net profit for the year. Okay, you can write it there. So they just give you 4 lines for a calculation that needs 5. Okay, so be careful, don't fall onto the trap of the one who's setting the paper, okay, giving the format. Okay, so finish these 4 items. So we have 1 short question remaining, 2 marks. Explain, referring to an appropriate accounting concept, why John made an adjustment for insurance paid in advance. Okay, prepayment. Okay, why? Of course, we always give this accounting concept, the accruals concept. Accruals concept, or you can also say matching principle. Okay, but then usually when they say accounting concept, I will give concept, I will not give principle. Okay, but then I just want you to know that this accounting concept comes from the matching principle. These two are usually interchangeable. Okay, both accepted. So it is because of the accruals concept. It is an application of this concept. okay? But then two marks, okay? You have to explain, okay? So this accruals concept means that we have to record our expenses when it is incurred, okay? Record when it is incurred, okay? When does it happen? When do you have to pay for it? Okay, so record the expenses when it is incurred, not when it is paid. Okay, if you have to further explain it, so you can explain that even though you have paid for insurance, okay, but then it is related to expenses for the next year. Okay, that's why you have to reduce the amount so as to get the correct correct expenses and to reach the correct net profit. Okay, so this is what follows this logic. Okay, but then for 2 marks, it would be nice if you just mention the concept and then mention what that concept is about. Okay, so 2 questions down. Okay, the time now is 9:22. Not bad. Okay, but then not really that good. Okay, so question 3. Question 3. Jeff and Sage, partnership. Okay, this is a partnership question. Partnership, but then let us have a little peek into what comes next. It is a dissolution of partnership. Okay, dissolution of partnership, and we have to explain something and then state the current account. State what the balance means. Okay, so 4 marks explanation things. Okay, and then current account of Jeff, realization account for the dissolution of the partnership. Okay, and then calculate how much money should be paid to Jeff. Okay, so this is dissolution of partnership. Let me change it first. Dissolution of partnership. Okay. So 18 marks for this dissolution. Okay, so first of all, explain one reason why a partnership maintains separate capital accounts and current account. So for partnership capital account, there are 2 system. One is called the fixed capital system. One is called the floating capital. Okay, that is, if you have a capital account and a current account, then it is a fixed capital system. Okay, capital is fixed according to the amount of investment that is made. Okay, this is also according to the original capital that you register. Okay, usually you won't change it in your daily operations. Okay, so what will be changed, or the changes due to the daily operations, that is the appropriations, the drawings, okay, will go into your current account. That is a fixed capital system. Okay, when we are working on sole trader, usually we have a floating capital system. That is, okay, everything including the investment, injection, the drawings, the profit for the year, go to the balance of the capital account. So it will be changing. That's why we call it a floating capital system. Okay, so why 2 marks? Okay, one reason. Okay, usually I would say for this, because capital is registered with the government. Okay, that's why we do not want to always changing it. Okay, so this is usually the first explanation that I would like to give. Okay, and also we can say that, okay, we want to know clearly what how much investment is made for each partner. Okay, and this amount is agreed in the partnership agreement. Okay, that's why we don't want to change it. Okay, so I can say fixed capital show clearly how much capital is contributed by each partner as agreed in the partnership agreement. Okay, so if I have to further explain why I want to show clearly the capital contributed, okay, because okay, this can also effectively control the amount of drawings, okay, because as the partners, okay, you are not afraid of your partners giving in more capital, okay, that is increasing in the amount of capital, okay, you might not be afraid of that, okay, but then you might be afraid of your partners taking out too much money from it, too much drawings, okay. So if you have a separate account, okay, you can see if you have negative balance in your current account, you can withdraw no more money, okay. So it is controlled by how much appropriations is given, okay, because you cannot withdraw more than what you have in the current account. But then if you mix the two together, you cannot clearly see how much is allowed for the drawings. Okay, so this might be one of the answer that you can give. Okay, so state what the balance of each partner's current account. So this, okay, usually will be one positive, one negative. Let's see, the current account of Jeff is a debit balance, okay, while for Sage it is the credit balance. That means positive balance. Okay, so we can see Jeff is a positive. No, the other way around. Jeff is negative, Sage is positive. Okay, but then it asks you what it means. Okay, so for negative balance, okay, it is the amount owed by Jeff to the business. Okay, so for positive balance in Sage current account, okay, it is an amount I do not want to say owed, okay, but then it can be like that. Okay, let me explain later. Amount owed by the business to Sage, the partner. Okay, why do I not want to use the word owed? Okay, because the company owed Sage money. It seems that it is a liability. I do not want this. Okay, but then I have no problem using the word owed for a negative item, because this amount have to be settled by Jeff to the business. Yes, of course. Okay, so we can use this officially, and I do not like. Okay, so I would say if I have a choice, then I would say this is an additional capital or equity, okay, beyond the agreed capital that belongs to Sage, okay, or that Sage had the right to withdraw. Okay, that feels better. Okay, but then it is okay for both. Okay, so next one, we have to work on the current account and the realization account. Okay, and we have to look at what is given to us in the question. What current account, right? Of Jeff, is it? Yeah. Let me change the order of the question a little bit. Okay. So Jeff and Sage were in partnership, sharing profit and losses in a ratio of 2 to 1. The partnership agreement provided for 10% interest per annum on opening capital. Okay, good. Opening capital is good. Okay, and salaries for Jeff 24,000. Okay, and then the partners' drawings 600 per month. During the period ended 31st December. Oh, why it says period? Okay, there must be something interesting happening here. Yes, okay, because you have a year start of 1st of April, and then you are dissolving the business on 31st December. How many months? April, May, June, July, August. What? September, October, November, December. 9 months. Okay, so for January, February, March, 3 months. So yes, 9 months. Okay, so always use your fingers for calculating, for counting months. Okay, don't be shy about that. So 9 months. Okay, then we have to be careful because for the interest per annum, 10%, no problem, but then make sure you multiply by 9/12. Okay, 9 months interest only. Okay, 9 months salary only, and then 9 months drawings only. Okay, so you are then given the capital balance and the current account balance of both partners, and the share of losses after appropriations. Okay, they are losses. Share of losses, we have to be careful. Okay, and then we have the partnership dissolved. Okay, it will go into the dissolution account, realization account. So before that, we can finish the current account of Jeff. Okay, let us do it first. Okay, so opening balance of Jeff's current account 44,800. Jeff. Okay, current account is capital in nature, so it is a credit side account. Year 2020, is it, or 21? Let me see, should be 20. Yes, year 2020. So you have a debit balance on the 1st of April. Balance brought down 4,800. Okay, negative. Okay, and then you have to have the appropriations on the 31st of December before dissolution. So 31st December, you have state appropriations maybe. Okay, you can write statement of profit and loss account appropriations or appropriations only. Appropriations account. Okay, so you have what? Salary here. You have interest on capital. Okay, we will calculate later. And then here you also have drawings, and you have appropriation account. Okay, you have do you have interest on drawings? Do you? No? Okay, no interest on drawings. Okay, but then you still have, you still have one thing, that is your share of loss. Okay, so after this, okay, you will have your closing balance. Okay, but then this balance will no longer be brought down to the next period. Okay, because it will go into your capital account. Okay, so let's see. Salary 24,000 a year, but then you only have 9 months. 24. Okay, so you have 18,000. Okay, so interest on capital. You have 10%, so 10% here, 9 over 12. Let us calculate 150. 10%, 9 months, 11250. Okay, let us remember this amount first. And then total drawings, you have 6,600 per month for 9 months. Okay, 600, 95400 total drawings. And also share of loss after appropriations, 11,000. Okay, so we have these 3 amounts. Okay, drawings 5400, share of loss 11,000, interest on capital 11250. So the balance being 11250, 4,800. 5. Okay, you have the balance being 8050. Okay, and then close. Okay, remember you always put the I never like to write the total. I always skip it when I work on it, but then I have to make that good habit for myself. Okay, so this item I've just mentioned, it will go into the capital account of Jeff. Okay, so don't just write capital. Okay, remember, always write capital of Jeff, because you have 2 capitals account, one for Jeff, one for Sage. Okay, so finish, 6 marks here. Next, realization account. We haven't read anything about realization yet. Okay, let us go on. On 31st of December, the partnership was dissolved with dissolution cost 1251285. Assets and liabilities were settled as follows. Okay, so assets and liabilities given to you the original balance, property, plant and equipment, inventory, trade receivable, trade payables, no other things. And then the settlement. Jeff took machinery, valued this amount. Sage took another vehicle. And then premises sold for 180,000. Inventories sold. And then trade receivables. Okay, we are owed 42500, but then only received 38,000 for it. Okay, trade payables, we also have settled for less. Okay, so there are 2 ways to work on trade payables. Okay, I will tell you a bit later. Okay, when we finish. So realization account. For realization, what we are doing is, okay, I like the word dissolution more, because dissolve, okay, from something to nothing, okay, dissolved. Okay, realization. Okay, we have assets and liability, how much we can realize, how much we can change it into cash. Okay, realization. Realize means change to cash, okay, in accounting. Okay, so we are selling everything. Okay, we can also say, we can also imagine that we are selling payables, but then it is so strange to say that. Okay, but then we have to pay. Okay, if selling our asset is changing it to cash, okay, then selling, so-called selling payables, okay, realizing payables, then we use our cash, okay, to settle for our trade payables. Okay, very strange indeed. Okay, so what we need to do is, okay, I imagine that the realization account is a large dissolution account. We put everything we are going to sell, we are going to get rid of in our realization account. So asset, we have we still need the date. Okay, so year 2020. I hate putting the date all the time, but then we still have to do it. 31st December. Okay, how many type of asset do we have? Property, plant, and equipment. Okay, I will put all the items first. I think we have inventory. 31st December. Do we have trade payables? Okay, we have to go back and see. Okay, trade receivables, trade payables. Okay, so trade receivables here. Okay, and 31st December, trade payables here. Okay, let me fill in the information. 213,775. Inventory 24500. Trade receivables 42500, and then trade payables 37500. These are all the book values. Okay, just like in that disposal account, we will put the book value first. Okay, book value being cost minus accumulated depreciation, right? Okay, we'll put the book value. Okay, and then see how much we can realize from these assets and liabilities. Okay, so asset in the debit side, when we realize some asset, we change it to cash, so it goes to the credit side of the dissolution. Okay, we have income, we have amount received, debit, bank, credit, realization. Okay, so the amount that we realize will go to the credit side of your realization account. Okay, so amount realized, I will use green. Okay, 31st December. So first of all, you go to the capital account of Jeff and of Sage. They have assets taken over. Okay, let us go back and see. Jeff took over machine. Okay, 43560. Sage 18940. Okay, so when they take away the asset of the company, it is actually a reduction in their capital. That's why it goes to the capital account of the two partners. Okay, 43560, 18940. Let me go and check. Let me make sure that is correct. Okay, for the correct person. Okay, yes, it is correct. Okay, and then for the other three, okay, property, the premises is also sold. Okay, so we receive cash for it. Okay, go into the bank account. Inventory, also bank account. Trade receivable, okay, also bank account. Amount received. Okay, so let me write down 18023, 23,000, 38,000. Okay, so 31st December, we receive money, okay, for these three. What? For premises, inventory, okay, they are not giving us enough lines again. Okay, and also trade receivables. Okay, but then you see it goes into the bank account. Okay, it doesn't go to the premises, but then I write here in separate line showing that, okay, we sell premises for how much, and how much. Okay, so 180,000, 23,000, 38,000. Okay, and then we have to pay for our payables. 31st December, bank. Okay, we are paying for our trade payables. Okay, trade payables. Okay, how much are we paying? 35,000. Okay, one payment, and then I will also deal with another payment, that is our dissolution cost, 1285. Okay, so 35,000 here, and then 1285 another payment. Okay, this is the dissolution cost. Okay, so here we have finished all. The remaining part is we have to calculate the dissolution gain or loss. Okay, so usually it is a loss. Let us see if this is the case here. 13775 42500 35 1285. Okay, we have let me see. Let me calculate one more time. I am so afraid that. Okay. 37500 4 3560 18940, and then 180 23,000 38,000, giving 341000. Okay, 213 24500 35,000. Okay, 5,000 1285. Okay, so here total 317. Okay, so total we have 23940 as the dissolution loss. Okay, so the 1st December it goes into again the capital account, okay, as dissolution loss, okay, of Jeff and of Sage, okay, 2/3 and 1/3, okay, 7980 and 15960. Okay, finish. Okay, so I mentioned that there's another way to deal with trade payables. That is, we do not put the trade payables here. Okay, so if we do not do that, then for this payment will also be treated in another way. Okay, so here what we can do is to put the net amount. Okay, net amount of the two sides, okay, 37500 and 35,000, the net amount. Okay, so you can see we have credit and then debit here. The net amount will be 2,500 here, credit. Okay, it means that we owe them that much, but then when we pay, when we settle the account, we settle for less. Okay, that means we have a discount received, okay, which is an income, so it goes into the credit side of the account. Okay, so in this case, okay, why do we have this second way of doing this is for realization account, it is going to realize our asset. Okay, so if we are only dealing with asset, then we shouldn't put trade payables here because we are not realizing our trade payables. Concept is like this. Okay, but then when we look at the past papers of LCCI, they somehow use both methods. Okay, they are not consistent. So here I would use the same method as the answer key provided. Okay, so that if you look at the answer key as well, you would not be confused. Okay, but then make sure you know you can use also use the other way, that is the net method. 2,500 go into the credit side of the realization account, okay, and that would be your discount received. Okay, but that the description should still be trade payables. Okay, but because this amount come from the trade payables account. Okay, so that is all for this part, realization account. Okay, let us go to the last part, that is the calculation of how much money was paid to Jeff on the dissolution of the partnership. Okay, so originally Jeff had capital of 150,000. We have to calculate. Okay, from this 150,000, okay, we have appropriations. Appropriations is already done, but then we have the balance from current account, and then from the dissolution, how much is still owed to him, to Jeff. Okay, so 150,000 opening balance. Okay, what's next? Okay, what happened to my iPad? It's not working. Okay, wait. Okay, wait. Okay, wait. Okay, so 150,000. What's next? Let me highlight it. Okay, capital of Jeff 8050. Okay, so this one will go into the credit side, because you can see debit current account go into the credit side of capital. Okay, that is an addition, 8050. Okay, so 8050 positive. Okay, and then actually this is a dissolution gain, not a dissolution loss. Okay, dissolution gain here, gain. Okay, because it goes into the debit side of the realization account, meaning the credit side of the realization account is greater than the debit side. Okay, that means it is a gain. Okay, so Jeff 15960. Okay, it will again go to the credit side of Jeff's capital account, addition 8050, and then 15960. Okay, but then we have one negative item. We have assets taken over here. Okay, so assets taken over, and also the dissolution gain, realization gain. 43560. Okay, let me write down quickly. 43560, is it? Okay, so add how much? 8050, add 15960. Okay, let's see. 150,000. 15960. 1 is equal to 130,450. Finish. Yeah. Good. 18 marks. Okay, so let's take a break. Okay, give me around 5 to 10 minutes maybe. Okay, let me rest a little bit, and you can take a rest too, or you can take a look on the coming questions that you have. Okay, so the coming one you have, I think it is, statement of cash flows. Okay, difficult things. Okay, and then question 5, is it single entry or what? Okay. Oh, interesting question. Okay, so see you in 10 minutes. Okay, it is 9:56 here. Okay, so 10:06. Okay, so see you. Okay, I am back. Okay, so we have 2 more questions to deal with. Let me refresh. Okay. Okay, so let us go back. This time it is statement of cash flows. Let me change the question detail first. Statement of cash flows. Okay. Okay. So, statement of cash flows, we are given the opening and closing balance of the company Chancliff Limited. Okay, so property, plant and equipment, bank loan, cash at bank, inventory, revaluation reserve, we have to be careful. And we have share capital increased, share premium, a decrease in the share premium. Okay, short-term investment 15,000 from nothing to something, and then trade receivable, trade payables. Okay, let me check one thing first. Okay, 15,000. Okay. From this to this, okay. So, and then we are given some transactions that has taken place during the year. Okay, and what we have to do is to state the interests of each stakeholders, and then do the reconciliation of the profit to cash flows from operating activities, and then the whole statement of cash flows. Okay, 9 marks. Okay, and then some explanation questions. Okay, so stakeholders. Okay, why are they interested? Okay, state the interest of each stakeholders in the statement of cash flows. Why are they interested in the statement of cash flows for these 3 stakeholders? Okay, so for shareholders, okay, they are interested. Okay, there are different things we can answer. Okay, so if they are shareholders, then they are looking for, first of all, of course, the financial health. Okay, for me, I would say there are 2 major things that we can say. Okay, if I'm a shareholder, then I am most interested, first of all, in whether the company can pay dividend. Okay, whether the company can pay us dividend or not. Okay, because if you have no cash, you have to borrow from the bank to pay dividend. It is not that good. Okay, if I am more interested in the long-term growth of the company, I would see if it is in good financial health. Okay, because in the short term, I would like to have dividend, but then in the long term, if it is growing healthily, of course, I do not have to be afraid of dividend, and I can enjoy the capital gain from selling the shares if the share price go up. Okay, so whether it will continue to grow. Okay, so I can say something like this. Okay, 1 mark for each point, so you do not have to give so much in detail. Okay, this just state the interest. Employees, we are always looking for job security. Okay, and also whether it is possible to have a raise in salary. Provider of financial external finance, okay, always whether they can repay the loan in time. Okay, not just the loan but also the interest, loan and interest. Okay, because if the loan is not yet due, then yearly or half yearly, I will receive the interest. Okay, but then if there's no cash, if the financial health is very bad, okay, then they may not be able to pay us interest, not mentioning the large amount of loan that we need to need repayment from them. Okay, so 3 marks. Okay, easy marks for you. Okay, so statement of reconciliation of profit to cash flow from operating activities. Let me draw the format first. Okay, 2 columns would be enough. Okay, so let's see what we have. During the year, the following took place. 1st of October, okay, share dividend. Okay, here we do not just work on the first part, the reconciliation. Okay, we will deal with it on a whole. Okay, and then see what figures go into which part. Okay, because the first part would be your operating activities and then investing and financing. Okay, so we'll do this together at the same time. So 1st of October, there is a share dividend of 0.15 per share paid on all the shares issued. Okay, so we go to share capital. Okay, the par value is £1 each, $1 each. And then at the beginning of the year, we have 280,000. So 280 multiplied by 0.15. Okay, so it is 42,000. That is dividend. Dividend is in the financing activity, and it is negative, a payment. 1st of January, year 2021, right issue, 1 share for every 2 shares held, made at a premium of 0.10 per share. The issue was fully subscribed. Okay, so originally we have 280,000 shares. Okay, 2 for 1. So we are issuing 140,000 shares. Okay, at a premium of $0.1. That means we are issuing at 1.1. So 140 multiplied by 1.1. We are issuing these shares for 154,000. Financing activities positive. Okay, we will receive 154. Okay, and with this, okay, here let us mark down. Okay, there is an addition of 140. Okay, and share premium of 14,000. Okay, so next, a bonus issue. No, right after, not right after, but 4 months later, we also have one bonus issue. 1 share for every 7 shares held on that day. For a bonus issue, there is, there is no cash received. Okay, and the money is from reserves. Okay, so let us look at how much. So originally we have 280,000, and then we have issued 140 more. So 280,140. So now we have 420 before the bonus issue. Okay, and we have 1 share for every 7 shares held. So divided by 7, we have 60,000. The bonus issue is for 60,000. So let's take a look at here. So share capital, we are going to add 60,000 more. 60,000, and this amount, okay, should be from share premium. Okay, minus 60,000 there. Okay, because it says the directors decided to leave the reserves in the most flexible form. That means we are going to get the money from non-distributable reserves first. Okay, capital reserves. Okay, so what's next? Okay, next we have equipment. Disposal of equipment. Okay, so what's the problem of it? Equipment costing 65,000 with a carrying value of 39,000. Okay, carrying value, be careful. Okay, let me erase what is on top first. Okay, because we've already finished this part. Okay, so equipment costing 65,000 with a carrying value of 39,000 was sold at a profit of 3,500. There were no other disposal of property, plant, and equipment. Okay, so one disposal. Okay, but then when we look at this, okay, we have to be careful. Okay, because for statement of cash flows, we have 4 items related to property, plant, and equipment, non-current asset. Okay, and we have to find the 4 items. So let us start with it. Okay, I will write the closing balance in a better way to enable us to make the calculation. So opening balance and then closing balance being what? I cover the amount, I can see. Okay, 840,000. Okay, and then 138,000 for accumulated depreciation. Okay, and then let me cover it in white. Okay, so that we can have more space on this. Okay, so to find the 4 figures, we need to do reconciliation from the opening balance to the closing balance. We have to look at the movement. Okay, the movement of non-current asset from the beginning to the closing balance. Okay, so disposal of asset. Okay, later we look at this. Disposal of asset, we have this one, proceeds. Okay, how much we receive from the disposal. Okay, and then less, this is the carrying value of the net asset disposed. How do we find the carrying value? It is the cost minus accumulated depreciation. Okay, and then we will have the disposal gain or the disposal loss if it is negative. Okay, so we can always use this to help us find the all the items related to disposal. So the equipment cost you 65,000, and then this time you are given the carrying value, so 39,000 goes into here. Okay, and because of this, okay, you will know the accumulated depreciation of the assets you dispose of. 85,000 minus 26,000, you have the carrying value that is given to you. Okay, simple equation help you find that item, 26,000. Okay, and this time you are given that you have a disposal profit of 3,500. Okay, you can find the proceeds from the disposal gain, and also the carrying value. Okay, so 35,000, 3,500, 39,000. So you have 42500. Okay, so you fill in everything that you need for the disposal. Proceeds 42500, cost accumulated depreciation, given to you the carrying value, and also given to you the disposal gain loss. Okay, and this, it go back to the movement of the non-current asset. For non-current asset, what happens here? Okay, what goes into here? You have several items. Okay, so for the cost, if you have purchases of new non-current asset, property, plant, and equipment, it is an addition. Okay, and if you have revaluation, it goes into here. But then if you have disposal, negative. For accumulated depreciation, if you have depreciation, it is an addition. You have more accumulate, right? Okay, and then if you have disposal, then the accumulated depreciation of the disposed asset go into the disposal part. Okay, so you have to know this movement for you to work on this. Revaluation, okay, is not always there, but then it is there because you know revaluation reserve go up. Okay, why do you have an increased revaluation reserve? Because during the year you have revalued your asset upwards. Okay, that's why you have to increase in the amount of revaluation reserve, and for this increase in the value of the asset, there is no cash effect. You are not paying anything for that increase. Okay, so having said that, we will fill in the items there. Okay, so here you have increased 20,000, it goes into here, revaluation. Okay, and then disposal, here the box in gray, you are selling, okay, assets that cost you 65,000 with an accumulated depreciation of 26,000. Okay, so the remaining part of the equation is your depreciation and the payment that you make to purchase new property, plant, and equipment. Let us calculate how much is that. Okay, 657, 20,000 minus 60. Okay, minus 840. You have 228,000 purchases. Okay, and then depreciation 98, 96, 128, you have 66,000 for depreciation. Okay, now going back to the statement of cash flows, that 4 items related to non-current asset. Okay, I will use green. Okay, green is good. Okay, so 4 items. First of all, you will have the amount you pay for the purchase of non-current asset. It goes into investing activities, negative, because you are paying money for this. Okay, and then operating activities, you will have depreciation expense. It is an adjustment for non-cash item. Operating activities. Okay, at least you will have two. You have purchases of new asset and then depreciation. Okay, usually you have these two, and I mentioned 4 items. Okay, that is, if we have disposal of asset, then we have the 2 additional items. Okay, first one is the proceeds from the sale of non-current asset. It is a positive investing activity. You receive money for it. Okay, and then you have the disposal gain or loss. Okay, this time it is a gain, so operating activities negative because it is a non-cash income. Okay, you do not have any cash related to the disposal gain. Okay, you may say that, well, is there really no cash involved? Okay, but then we sell the asset for cash. Why is there no cash involved? Because the cash involved is in the proceeds. Okay, we have already calculated the cash proceeds in the investing activities. The gain or loss is a non-cash item. Okay, so you can imagine, what if it is a loss? You're not paying money for the loss. Okay, you just receive less money than it is worth. That's why you have a loss. Okay, but then the cash effect is just in the proceeds from the sale of non-current asset. Okay, so 4 items there you get for the non-current assets part. Okay, so let us deal with the remaining items. Let me use maybe orange. Okay, so after the disposal, you have one last item related to the profit for the year given to you directly, 77200. Okay, it is our first item for our reconciliation of profit to operating activities, cash flows. Okay, but then we still have to deal with the remaining items. Bank loan from 275 to 200. There is a decrease of 75,000. Okay, you have repayment of bank loan. That is a financing activities because it is a repayment. You pay cash. Okay, so cash at bank from 45,000 to 12,000 credit overdraft. Okay, that means you have a big decrease. Okay, but then here, okay, we have to deal with this cash at bank with one more item. That is the short-term investment. Short-term investment is also cash and cash equivalent. Okay, so you should look at cash at bank and short-term investment together. Okay, so negative 12,000 overdraft with short-term investment 15,000. Okay, that means you now have cash and cash equivalent of positive 3,000. Okay, positive 3,000. That means from 45 to 3,000. Okay, you have a decrease of cash and cash equivalent 42,000. Okay, this will be our last 3 items of the statement of cash flows. Okay, here let me use another color. Okay, orange is too light for me. Maybe brown. Okay, so inventory. Okay, 15,000 to 150,000 to 190, so 40,000 increase. Okay, operating activities negative. Revaluation reserve will finish. Okay, at 20,000 it will go into our workings for the property, plant and equipment. Share capital, let us see whether the movement is done. 280 plus 140 plus 60, yes. Okay, 4800. Okay, share premium 115 plus 14 from the issue minus 60 because of the bonus issue, 69,000. Yes, finished. Okay, short-term investment finished. Trade receivables 167 to 145. There is a decrease of 22,000. So decrease. Operating activities positive. Trade payables 132.5 thousand, 117.3. You have a decrease of 15,200. operating negative. Okay, so we have finished finding all the items. Okay, and let us go on and put the items there. Okay, first item, we will have the net profit for the year 77200. Okay, and then adjustment for non-cash item, that is, you have depreciation. Depreciation is added to it, okay, because it is an non-cash expenses deducted from net profit, so the adjustment you need is to add back. Okay, less disposal gain. Gain is a non-cash income that is added to net profit. Okay, to reconcile with cash flow, you have to take it away. Okay, so depreciation, how much? 66,000, so 66 add, and then 3,500 negative 66,000 25 62500 139700. Okay, then I use another color. And then next we have increase. Is it increase? Yes, increase. The sign first. Increase in inventory. Add decrease in trade receivables. Less decrease in trade payables. Okay, no interest, no cash given to you. Okay, so we have 40,000 here, and then what, 22,152. Okay, 22,15200. Okay, 40, 22,15200, 33,200 negative plus 139700. Okay, so we have 106,500. That is net cash from operating activities. Okay, finish one part. Okay, next we have another part of the statement of cash flows. Okay, we'll start with the balance. Okay, 106,500. Okay. Okay. My cat is playing, with those packaging of the snacks. Okay, very bad. Okay, so this is from the net cash from operating activities. Okay, usually you also give the heading. Okay, so cash flows from, okay, sorry for my bad handwriting. Okay, so next part we will have investing activities. Cash flows from investing activities. Okay, for investing activities, you have two sides of it. Okay, one is internal, one is external. This time you do not have any external investment. Okay, here we have short-term investment. If we have just the term for investment, but not short-term, but just investment, then it is an external investment. If you have increased in that external investment, then you have paid. Okay, you have paid. You buy some shares of another company or debentures of another company. Okay, so here we only have internal investment, that is at, or I should write this one first, less payments for the purchase of I don't have enough space, property, plant, and equipment. Okay, and then add proceeds from the sale of property, plant, and equipment. Okay, so how much we have paid for the purchase, we have already calculated. Let me arrange a little bit first. Okay, 228,000 for the purchase, and then 425 for the proceeds. 228,000 negative, 425,000 positive. Okay, so negative 228,000, 425,000, 185,000, 185,500. Okay, so this is the net cash used in investing activities. Okay, next part, financing. So we have dividend paid less, okay, what else do we have? We have repayment of loan, right? Less repayment of bank loan. Is it a bank loan or just loan? We'll see later. Add the right issue, okay, or you can say proceeds from the right issue. Do we still have anything else? We will see. Okay, go back to the question part. Bank loan, yes, it is. So 42,000 for the dividend, 42, and then bank loan 75, and then the right issue 145. Anything else? I guess no. Okay, you can see I marked down beside the figures that I need. Okay, investing, operating, and financing. It helps you count, okay, and identify the number, the figure that you have already worked out. Okay, so it will not be so easy for you to miss out any item. Okay, so dividend paid 42,000 negative. Okay, repayment of bank loan 75,000, and then right issue 154 positive. Okay, and total you have 42, 75, 154, 37,000 positive. it is negative. On the top I have written used in. Okay, be careful, because if not, when you work out the total, it will be incorrect. Okay, so net cash from financing activities. Okay, so last part. A, don't play with the packaging. No. Okay, so last three figures, you are going to see whether we have a net increase or decrease. We know already that we have a net decrease in cash and cash equivalent. Okay, so 106,500, 185,500, and 37,000. Yes, we have 42,000 negative. Okay, and then we have why are you playing with tissue papers? Hey yo. Oh, opening balance of cash and cash equivalent, and then closing balance of cash and cash equivalent. Okay, so you have 45,000 opening and then 3,000 closing. Okay, 3,000 being 15, I should say 12,000 bank overdraft. Okay, and then short-term investment 15,000. Okay, finish. Yeah. Okay, it takes much time for this type of question. We have spent more than half an hour on this. Okay, and haven't even finished the discussion part. Okay, discuss whether the company should finance the purchase of a non-current asset by the issue of shares or debentures. Okay, so it seems here we have financed it by an issue of shares, 154,000. Okay, for the purchase of 228, I think. Yes. Yes. Okay, so this is a question related to capital structure of a company. Okay, where whether it should be debt, okay, or it should be equity. Okay, so the question is usually on this. Okay, gearing. Okay, gearing ratio is not in the syllabus of LCCI level 3, but it is good that we know the concept. Okay, gearing ratio refers to how much refer to the proportion of debt that a company is in. Okay, so this ratio is the formula of this ratio is like this. Okay, if you have debenture, if you have bank loan, okay, if you have preferred shares, okay, it will go into this, because these are fixed cost capital. You have to pay the percentage of interest or dividend before you pay your ordinary dividend. Okay, so these are called fixed cost capital. Okay, so gearing ratio over total capital employed. Okay, so capital employed, okay, is the total is the capital employed, but that we know already. Okay, that is all your equity items. Okay, ordinary shares, preferred shares, reserves. Okay, equity plus your long-term liabilities, that is your debentures and your bank. Okay, so how much debt your company is in, the proportion of it. Okay, so if you have more, that means you have higher burden of interest. Okay, and it is also possible that when debentures, when the bank loan becomes mature, then you have to repay. Okay, whether you are able to repay the amount or not. Okay, if you are too much into that, then you have that risk of not able to pay your interest. You have that risk of not being able to repay the amount, the principal. Okay, so here the question is whether the company is heavily geared or not, heavily into debt or not. If it is not, then it is always okay to borrow some money. Okay, so on the other hand, if you are worried that you cannot repay, okay, then you issue shares. Okay, do you have any drawbacks on it? Of course you have. Okay, because when you issue more shares, that means you have more shareholders to share your profit in the future. Okay, and also if you issue more shares, that means you have more shareholders controlling the company. Okay, that will dilute your ownership, dilute your control over the company. Okay, so both methods have their pros and cons. Okay, and you have to decide. You can use both, but let us take a look at this company. Okay, we can see whether it's heavily geared or not. Okay, so your bank loan now is 275 at the start of the year. At the end of the year, you have repaid some of it, so you have less liability. Okay, so I would say it is not heavily geared. Okay, because you do not have high gearing ratio, not heavily in debt. Okay, because you have issued shares. Okay, but then if you do not issue shares, you issue liabilities to finance. Okay, then there might be a problem. Okay, because you might have more debt than your capital if you do that. Okay, so here I'm not writing everything down. Okay, but then I just write some notes. Okay, for debentures. Okay, interest is fixed. Okay, this is somehow good. Okay, and also control and shareholding will not be diluted. Okay, but then if you want to have for issuing shares, okay, then you can say, okay, avoid too much interest burden. And actually this method also permanently increase capital, equity, investment in the company, the size of the company. Okay, so give a conclusion at the end. Okay, you can support either side. Okay, it doesn't matter for this one. Okay, too much time spent on this one. Why are we taking so much time? Okay, last question. Question 5. On the 1st of January 2020, Jesse started a business by opening a bank account 16450. Okay, so sole trader. This one is sole trader. Let me change. Okay. Sole trader. Okay. On the 1st of July okay, that is mid-year. A machine was purchased. Economic life 10 years. Residual value 10,000. Full year depreciation is charged in the year of acquisition. Okay, we're not told about the depreciation. Okay, depreciation method 10 years. That means straight line. Okay, not given to us directly, but then it is implied. Purchase. The purchase was financed by an interest-free loan. Okay, 80,000, repayable in 5 equal installments made on 30th of June each year. Okay, this is the third time we see a loan repaid in installments. Okay, so we have to know this point. Okay, so 80,000, okay, and 5 equal installments. 80 divided by 5, that is, you have 16,000 as current liability, and then 64,000 non-current liability in your statement of financial position. Because I remember we have to work on the statement of financial position. Yes. Okay. Oh, still so much to do. Okay. So, during the year, credit sales, cash sales, credit purchases, inventory. At the end of the year, cash at bank, cash in hand. Okay, credit side means that it is, overdraft. Drawings 10500. Profit for the year as a percentage of revenue 10%. Okay, so you have net profit. And then trade receivables collection period 70 days. Payables payment period 30 days. Okay, so calculate. Okay, for the year end, okay, trade receivables and payables. Okay, so 70 days, 30 days. Okay, and then credit sales, credit purchases 91250, 109500. Okay, so the trade receivables collection period is trade receivables over credit sales is equal multiplied by 365. You have the collection period. Okay, so here we do not know trade receivable. Okay, what to do is trade receivables, let us still make it an unknown, and then credit sales being 91250 multiplied by 365, you have 70 days. So trade receivables is equal to 70 91250 divided by 360. So you have 17500. Trade payables over credit purchases 109,500, 365, 30 days. Okay, so 11500 divided by 356 is equal to 9,000. Okay, so prepare a statement of financial position. Okay, space for workings given to you. Okay, 13 marks. So I will draw the format first. 3 lines, 2 lines, okay, 3 lines. Okay, because I would like to show the cost, accumulated depreciation, carrying value. Also, because you have non-current liabilities, it would be nice to have 3 columns as well. Okay, so non-current asset. Okay, is it machinery? Yes, I think so. So machinery. Okay, so you have only 1, so no total needed. Current asset. Okay, you have inventory. I do not remember if you have any other receivable. I don't think so. Trade receivables, no allowance for doubtful debt, and then you have cash in hand. Okay, and then total asset. Okay, so let's see here. Okay, total asset. Okay, and then next part you have equity, opening balance. You have profit for the year. Okay, this one we will have working. Do you have any drawings? Are you given any drawings? Okay, I think you have to calculate. Okay, let me look at one more thing. Okay, I think you have one more item. Apart from this opening balance, you have additional capital during the year, because for the purchase of machinery, okay, part of it is provided by the loan, and then part of it is provided by Jesse. Okay, profit for the year. Okay, and then drawings. Okay, and then closing equity. Okay, here I think drawings, you will have to find it by yourself. Okay, so this one, let me put a heart here. Okay, and then last we have liability. So we'll start with non-current liability. Okay, we have a bank. Is it bank loan or just loan? Let me check. Interest-free loan. Okay, so just loan. Okay, and then current liability. Okay, you have trade payables and also a bank overdraft. Okay, total equity and liability. Okay, so we must be able to, balance, because okay, we have to use the total to help us find drawings. Okay, push back. Okay, that's why we don't have to worry. Okay, it's not, we are not able to worry. Okay, so let us fill in all the information that we need. Machinery, the cost is 130,000. Okay, so workings. Where is our working one? Okay, then we make this our working one. Okay, machinery, for the depreciation for this year, working one. Okay, we can show it in the last page, I mean in the previous page, but I will show it here. Okay, so we have 13,000, and then the residual value 10,000, and then it will be used for 10 years. Okay, so it would be okay, 12,000 Okay, so 118,000, 1130 minus 12, yes. Okay, inventory given to us directly. Let us take a look, 20,000. Okay, let me also put in the cash in hand, cash at bank. Okay, inventory, how much? 20,000. Cash in hand, 5500, is it? Okay, and then overdraft is 1500. Let me go back. Yes. Okay, trade receivables. We have calculated where is it? Here. Okay, 175,000 and then 9,000 for this. Okay, 17500, 17500, and then trade paper. I realized one more thing. We have to add one more item. Okay, let me erase this first. This one. Okay, trade payables, because we have the loan here. Okay, I almost forget. Okay, so trade payables 9,000. Okay, so we finish asset. Let us calculate the total for the asset. 175,5500, 43,000. 43 plus 118, 161,000. Okay, so liabilities part first. Okay, loan, we have 80,000. The loan is 80,000. Okay, and then divided into non-current and current. Okay, the current, next year we have to pay, we repay 1/5 of it. Okay, so 64,000 here it is. This working is also done. Okay, when we look at the question. Okay, so non-current part is 64,000, current part is 16,000. Okay, I almost missed out that part. Okay, 16,000, 9,000, 1,500. Okay, we have 26500 plus 46,000, 90500. Okay, I will always use 3 columns if we have non-current liabilities and more than one item of current liabilities. Why? Because I want to show total non-current liabilities and I want to show total current liabilities as well. Okay, if you just put it in one column, then you don't have this information. If you are asked to work on, current ratio, asset test ratio later, then you have to find current liabilities again. Okay, this is not good formatting. Okay, and after I have non-current and current liabilities, I can also show total liabilities. Very useful information. The 3 items that I put a tick. Okay, that's why I showed like this. Okay, and usually format in the answer provided by LCCI don't show like that. Not good formatting. Okay, so now we miss one part. Okay, that is equity. So we have to calculate the drawings from the total equity and liabilities. That's why we have to put 161,000 here. And with that 161,000 minus the total liabilities, we have 70500 here. Okay, so this one to this one. Very ugly line. Okay, so opening balance, we are told that the opening Jesse start the business with 16450. Okay, so 16450. Additional capital. Okay, we have how much? 13,000, 8,000. We have 50,000. Okay, and this one is the 13,000 machinery. Okay, 8,000 is the interest-free, 80,000 interest-free loan, and the remaining provided by Jessie, okay, from her personal savings. Okay, that's why. Profit for the year, we have been given that it is 10% of revenue. Okay, so calculation needed. Okay, credit sales and cash sales. Okay, so working number 2, working 2 here. Okay, credit sales 91250 plus cash sales 54250, and then 10% will be your net profit. 91250 54250, 10%, it is 14550. Okay, and with that, okay, we can know the amount of drawings. Okay, so the amount of drawings is 10500. Finish. Done. Yeah. Last 5 points, 6 points. Evaluate how Jessie's profitability may be affected by spending 25,000 on advertising. Okay, so so this one is we have the direct effect and the indirect effect. Okay, so evaluate. Okay, that means both sides we should mention. Okay, so first of all, when we have spending, okay, spending on advertising 25,000, it is an expense, so profit will go down, of course, one thing. Okay, but then because of this, okay, you may be able to increase revenue itself. Okay, selling more, by selling more, first thing. Okay, you sell more, so you have more higher revenue. Okay, but be careful. Higher revenue doesn't mean that it is always higher profitability. Profitability is that you have to compare it to something else. Okay, compare profit with your revenue. So when your revenue go up, profit go up, doesn't mean your profitability goes up. Okay, so be careful. Your revenue go up, profit will go up. Okay, but more importantly, if you advertise, if you are able to sell at a higher price, okay, then your profit goes up, and also your profitability will go up too. Okay, sell at a higher price. Okay, so please make sure you have this difference. Okay, so make conclusion. Okay, usually I would say because when we make an advertising expense like that, okay, the effect might not be immediate. Okay, and we can also mention the timing difference. We can also mention the the how much is increased. Okay, so we increase our expense by 25,000. So how much revenue will increase? Will revenue increase more than the expense we spend on advertising? Okay, if yes, okay, then profitability will increase. Okay, if no, okay, then and then profitability might not increase. So you can mention about the scale of how much is increased. Okay, so last, state one other way Jessie could improve her profitability. Always, okay, when we're talking about increase in profitability or profit. Okay, one way is to increase your income, another way is to reduce your expenses. Okay, so you can spend less. Okay, reduce expenses. Okay, so less wages paid, less general expenses paid, electricity, you switch off the aircon for longer hours. Okay, it can help you save expense, and then profitability goes up. Okay, so that's it for today. We have spent too much time on this. Okay, I don't know why. The statement of cash flows really take too much money, too much, time. Sorry, not money. Okay, although time is money. Okay, but then I hope next time we will spend less time. Okay, so our next paper, we have finished year 2022-21. Okay, and our next paper would be, let me see, year 2020 December. Okay, December. Okay, would be our next paper attempted. Okay, I think maybe on Thursday. Okay, we will do this 3 times a week. Okay, remember our target, 30 sets of paper before the exam. Okay, so see you. Goodbye.